hope you're all having a nice afternoon. Basically, very timely for this particular update, especially with everything going on in investment markets. Talk about inflation, interest rates, the war in the Ukraine, and certainly very, very volatile investment markets. So quite an opportune time for us to give an update to our clients about what's happening out there. And we're joined today with Isaac Poole. I'm Philip Richards, for those of you that don't know me, and I'm the founder, managing director, and financial advisor at Endorphin Wealth. And basically looking forward to running you through a few highlights and a little bit of information about, what's happening in the world out there as best as we know it. Isaac Poole, who we're joined with today, is working at Oreana Portfolio Advisory. For those of you who aren't aware, Oreana, we made a partnership with them about 3 years ago. And since then, it's been a really, a great partnership. And what effectively we were able to achieve through that is bolstering our investment capability. So that helps us to be able to navigate markets, have access to outstanding intel and people to obviously assist us in managing portfolios for clients so that we can manage risk, but also take advantage of investment opportunities as they arise. Oreana was actually the old NAB private bank based out of Hong Kong and is now owned by a Melbourne-based family office under the name of Oreana, hence how that came about. Introducing Isaac Poole, who has an extensive amount of experience across a whole range of wealth management positions, including chief economist at one point for the New South Wales Treasury and a significant role in head of capital markets for Willis Towers Watson. He's worked across the UK, Hong Kong, and also in Australia. So big welcome to you, Isaac, and thank you so much for your time today.
Thank you. Thanks, Philip, and thanks everyone for joining. I'm going to say it's a slight understatement to say that it's a challenging market at the moment. This is one of the most difficult set of circumstances for investors that I've seen in my career. There's been few places to hide, and there is so much going on across markets, geographies, asset classes that it has really been a difficult place to remain invested. But there are areas to look at, places to focus on, and some questions that I'd like to try and answer over the course of the next half hour or so. And then, of course, we can take some questions at the end, and very open to do that. But I do think it's worth focusing in on just how challenging it has been. And it's sometimes difficult to appreciate because we've had so many things coming at us over the last couple of years with COVID and more. It's easy to forget that this all seems to have coalesced over the last 6 months into a range of outcomes that are really, really impacting markets. And so we have COVID, which feels like it's in the rearview mirror for us here in Australia. It's not globally the case. Over in China, we still have lockdowns rolling along. We have supply chains globally that haven't fully reopened. Prices are being pushed up because of that. Growth is perhaps slower and slowing as a result of those supply chain issues, and it's continuing to impact the broader economy. And as Philip mentioned, we have a war going on in Europe and Eastern Europe, something that hasn't happened for many decades. It's now been going since February, where we're looking at months of this conflict. And while sometimes it's easy to forget and it does fade to the background in the news flow, it is having a really important impact on global prices. It's having a very important impact on Australia's economic outlook. And it's likely to persist for some time without a clear end in sight. We've had elections here in Australia, and that was something that a while back was still an uncertain outcome for our country. But we have elections coming up in the US in November. We have a National Congress taking place in China in October or November. Two enormous important countries and economies for global outlook, for the global outlook, with some uncertainty surrounding both of them. China itself, I mentioned the National Congress taking place later this year. It's still facing challenges from its property sector that really blew up a little bit in late last year. It's facing challenges from COVID. It's facing challenges from its technology regulatory outlook. This is Australia's biggest trade partner, the second biggest economy in the world. Those challenges are making it difficult for investors. And against all of this, we have central banks. I've got the US Federal Reserve here, but we know that the Australian RBA hiked, the Bank of England, the Bank of Canada, the Bank of New Zealand, and soon the European Central Bank. All of these central banks are hiking rates for the first time in nearly a decade in some cases. So we have that added to the uncertainty and the difficulties facing investors. And then these are just the things we know about. As we've found over the last couple of years, it can be the unknown unknowns that get you and come out of nowhere and can make things even more challenging. So we have a difficult last 6 months that's leading to all of this volatility and uncertainty that we're feeling right now, and it could persist for some time. And so that has been an incredibly difficult environment to invest in. There have been few, if any, places to hide over the last 6 months. And excuse me for this very busy chart. I know that there's lots of numbers there, but probably the key takeaway is that most of them are red. There's not a great deal of black on there. And you can see what I've tried to show here is our fixed interest in Australia. This is an aggregate number. International fixed interest, the typically defensive parts of the portfolio have not provided the sort of defense that we would like. They're down almost 10% in Australia over the last 12 months. They're down more than 10% in global over the last 12 months. And year to date, that's where most of the pain has been felt as government bond yields have surged, as interest rates have been hiked. That has weighed on returns in that defensive part of the portfolio and been challenging. Now, typically, when you see red, and you don't see that sort of level of red normally in fixed interest, typically when you see that red, you would hope to be seeing some green or black in your equity sleeve of the portfolio. It hasn't really worked out that way over the last 6 months. You can see year to date, Australian equities down around 3%, a bit more today. International bonds, international equities, down around 13 or 14%, a little bit more this month. This is all to the end of May, and we've seen more turmoil recently. And you would think or hope that a diversified portfolio is the way to go. Unfortunately, it's also suffered. A 60-40 portfolio, 60% equities, 40% bonds, has struggled in this scenario. This is the type of losses that we haven't seen before. A sort of a 6 month move or a 12-month move, 8% in a 60-40 portfolio is about double the worst previous outcome. So a really, really challenging start to the economy, for markets, for investors, and there's some really important reasons to be aware of what's driving that. And it is all about inflation at the moment. Now, at the start of the presentation, I talked a little bit about those uncertainties, COVID, the war in Ukraine, elections, China's challenges, and then I finished off with the central banks globally hiking rates. And that is the key narrative right now. It is all about central banks moving to hike policy rates for the first time in many, many years. And they're doing that because they've found inflation well above their central bank targets. And I'm not a lover of putting charts all over my presentations, but I really wanted to show this one because I think it shows it relatively clearly, hopefully. This shows the inflation rate, the annual inflation rate in Australia and the US. You have the US in orange, Australia in grey, And in between, there's a grey box, which is the target range for inflation for those central banks. So around 2 to 3% in the US and Australia. Inflation hit 8.6% in the US, the highest level in 40 years. It's hit 5.1% in Australia, the highest level since GST was introduced and for decades before that. Both of them may go higher in the near term, as we've seen energy, commodity and fuel prices push higher over the last couple of months. It is a inflationary environment in the near term in a way that we have not seen for decades. If you go back a couple of years ago, we had the challenge of inflation being too low, and you can see that on this slide. In the period between 2015 and 2020, inflation tended to be below the target. Central banks couldn't cut rates quick enough to get inflation back up to where they wanted it. Now they have the complete opposite, the completely opposite challenge, and so they've started to hike rates. Now, the challenge for investors, the challenge for central banks, the challenge for markets is how fast do they need to hike rates to be able to get inflation back to that target level? And there's no hard and fast answer to that. But some of those challenges I mentioned at the start, the war in Ukraine, COVID-19, China's difficulties in its economy are going to make it quite difficult for the central banks to be able to decide exactly how far and how fast they have to hike rates. Now, I say that for a few reasons. The first reason is some of this inflation is driven by supply side challenges. It's driven by supply bottlenecks, by supply chain disruptions that are coming about because of the war in Ukraine, because of the COVID-19 lockdowns, quarantines, and difficulties in getting goods shipped out of key countries like China. There is not a great deal the Fed, the RBA, the Bank of England, the European Central Bank, all of the other central banks can do about that. There's no real reason that a rate hike at the US Fed would help to bring energy inflation down at the moment, at least not to the extent that the Fed would like. These are being driven by shortages coming through from the war, shortages related to COVID. Now, I say that there's not a great deal that the Fed can do. Of course, they could do something if they wanted. They could hike rates to 20% or 25%, to the sort of level where families say, well, we're going to have to cut back on our food, or we're going to have to stop driving, or companies say, we just can't afford to manufacture anything anymore because we can't keep our lights on as well as pay our debt. But that's a possibility. It's just not ever been done before, and it's not really something the Fed is, or the Reserve Bank is looking to do. They don't want to kill the economy. They don't want to cause a recession. They don't want to force us over the precipice into a depression. And so they need to be very careful about the pace that they hike rates to control these. But they're not powerless. The Fed and the RBA and all the other central banks can do something about demand. Importantly, they can do something about housing, particularly here in Australia, and they can do something about wage pressures. And these are the areas that the Reserve Bank are focusing in on areas that they can help to cool the economy, that they can help to slow inflation, and importantly, that they can implement without necessarily forcing a recession. But it is a risk. There is a challenge and a real tightrope for the central banks to walk in order to hike rates just enough to slow inflation, but also not drive us into a recession. And that is what markets are grappling with day in, day out at the moment. It's what's causing so much volatility in equity markets, in bond markets, in credit markets, and I think is what is weighing on the minds of politicians, of households, of companies, of governments around the world. And that is an environment with that level of uncertainty that drives all of that red back in that first slide that I showed, where there was nowhere to hide. So just what can be done and how far can rates move, and what are markets expecting, and what is likely to take place? These are really important questions for the direction of markets from here, for the direction of the economy from here, and it's what all of the market participants that we speak to and that we look at are trying to come to grips with. And it's not easy because up until the start of this year, we had historically low cash rates in Australia. We had an historically low Fed funds rate in the US, and here it is, 0.1% in Australia, 0.25% in the US. These were rates that are as close to zero as it can realistically get in these economies. And it was considered appropriate because we'd just come through a pandemic. There was a lot of uncertainty about just how quickly the globe would recover, how quickly Australia, how quickly the US would recover. And of course, we didn't have the impact of a war in Eastern Europe on these driving some of the supply side pressures, inflation pressures higher. So this is a starting point at just only 6 months ago, or just under 6 months ago. Over the course of the last, I would say, 3 months, that has changed. The outlook has changed dramatically, and it's no more dramatically shown as it is in the Reserve Bank of Australia's response. Until around March and April of this year, the RBA was adamant that they would not need to hike rates until 2024. Just before May, they moved to say, well, actually, inflation is a little bit more sticky, a little bit more persistent than we expected. Prices do seem to be coming through a little bit on the wages side. There's a chance we may have to hike rates in 2023. And then, of course, we all know that in May, they hiked rates. And they hiked by what they thought was enough to just start the ball rolling towards removing some monetary policy. The Fed had already hiked rates. They'd already moved rates up close to 1%. But that set off a reaction in markets where markets got spooked by the change in the RBA's commentary. They've been spooked by the rapid change in the Fed's commentary, and they've moved from expecting virtually no rate hikes this year and having a virtually 0% interest rate at the start of this year to pricing in close to 4% by the end of this year. When you consider we're at 0.85 and 1% now, that means the market is expecting up to 3% rate hikes over the rest of this year. We've only got 6 months left. That's about 4 meetings in the US, about 6 meetings in Australia. It means that the markets are expecting, on average, a 0.5% rate hike every meeting for the rest of the year, slightly higher in the US, where they're now expecting a 0.75% rate hike tonight out of the US. And this represents a very aggressive, a very rapid, a very sudden, and a very sharp increase in rates, a tightening of monetary policy of the like that the world has seen before, but it's certainly caused some challenges for the economy when it's happened.
Zach, can I just ask a quick question? When you say the world's seen it before, do you know when that was and sort of how that played out?
Yes. Yeah, so it's happened in the US in the 90s when interest rates were effectively hiked at 0.25% every meeting for the best part of a year. And it pushed interest rates up about 400 basis points over the course of 12 months. Now, the Fed will look back on that and say that they achieved a soft landing. And they sort of did achieve a soft landing, but that also was a soft landing after a double-dip recession. So it was a challenging time for the economy, but a very different set of circumstances to what we have now. And so there is reason to hope that the Fed could achieve a soft landing. And I'll go through in a second what a soft landing looks like, but we don't see hope as a strategy. So while we might hope for the best, we also prepare for the worst. And we do that by thinking about scenarios that may play out if the Fed hikes or the RBA hikes less than what the market is pricing, and what may play out if the Fed and the RBA hike in line or even more than what the market is expecting.
Great, thanks.
So these are the market's expectations They're not the central banks, they're not the Feds, they're not the RBAs, but this is what investors are saying. And of course, that means that it may not happen. And we think that there's a good chance that these rates won't be achieved, at least by the end of the year. We think that somewhere between 2 and 3% in Australia is likely. And after last night with the RBA Governor, Philip Lowe, speaking that they're expecting inflation to be around 7% at some stage, it's probably more like 2.5% or so that we may get to by the end of this year. That compares with effectively a 4% expectation by the market. In the US, it's a slightly wider range of outcomes, we think, because the Fed has to hike rates a little bit more to impact the housing market. So there, it's probably somewhere around 2 to 3.25% that the Fed may get to, but still lower, we think, than what the market is expecting. And that's really important because it allows for the economy to reset, for markets to reset, if that is delivered. And if it is delivered, it would be a soft landing, we think, in the way that the Fed is hoping. So what is a soft landing? I've mentioned it a couple of times now, and it's quite important because a soft landing is one where the Fed and the RBA and all the other central banks manage to hike rates just enough to help bring inflation lower. They manage to hike rates just enough to slow growth a little, but they don't hike rates so much that they cause a recession. And this is what everyone is worried about. This is the really big concern for markets and why we've seen all that volatility, why we've seen all that uncertainty. Now, in our view, we think there's a good chance the Fed will hike somewhat less than the market is expecting. As I showed before, we think it's quite probable that rates move 200 basis points higher this year, maybe 250 in Australia, maybe almost 300 in the US. But that's still significantly lower than the 4% rate hikes that markets are expecting. And so that's a really important hallmark of a soft landing. If the central banks are able to hike less than the market is expecting, it would allow economic growth to remain above, maybe a little bit above trend, slowing from where it is now, but still remaining above trend. And that's important because we see in Australia that economic growth is above trend at the moment. The unemployment rate is at historic lows, and the same in the US. So being able to hike rates just enough that we remain above trend over this year and through the first part of next year is going to be an important part of a soft landing. Now, this is why why a soft landing is important, because right now we've seen US equities enter a bear market. They're down 20% year to date. It's a really challenging environment, and that tightens financial conditions. It effectively acts like another rate hike for the Fed. A 20% fall in equities is going to start to reduce spending in the US. And that 20% tells us that markets are expecting about a 50% chance of a recession, because a typical recession is a 40% decline from peak to trough. So half of that is 20% chance of recession. If we get a soft landing, then that 50% risk of recession needs to be priced out of the market. And that's going to be a really important part of an economic recovery, of allowing the Fed to hike less, but growth to continue to recover. And so what should we look for here? We think the important part to keep an eye out for is a change in the narrative. And a change in the narrative from the Fed, or a change in the narrative from the Reserve Bank, one where they say, we've hiked rates quite a lot now. The Fed funds rate is at 2.5%. The RBA cash rate is at 2% or so. We can see it is impacting household decisions. We can see it is impacting growth. We can see it is helping to bring inflation back towards our target. We think we can pause and see what the data are telling us. We may still have to hike, but we won't have to hike so aggressively. And it's that commentary, that narrative shift, that is going to be really important for the Fed and the RBA, showing that they're achieving a soft landing. So that's something that we're keeping a very clear eye out for, something that we think is going to be really important for the near-term outlook and the medium-term outlook in making sure that we can continue to recover. But I said that there were risks around that, and there's one very big risk, and I mentioned it before. Equity markets are pricing that risk. There's a lot of commentary out there about this type of a risk in the US in particular, less so in Australia, for reasons I'll speak about, but it is the risk of a policy error by the Fed, by the Reserve Bank of Australia, one where they hike rates too far and risk tipping the economy into some sort of recession. And that is being priced in that sea of red that I showed earlier on in all of those slides. That is the risk that markets are deeply worried about as interest rates start moving higher. It's got markets jittery. It's got them talking about this, and it's putting downward pressure on prices. And it is entirely a risk that sits, in our view, with central banks. They need to walk a tightrope of hiking rates just enough to slow growth and slow inflation without tipping over recession. And we are worried, this is in our scenarios, that a rate hike path to 4% or above 4% this year would be very challenging for the economy to digest. There'd be a lot going on there, and it would be felt across households, and I'll show why in Australia shortly. It's likely to push growth below trend, and that could start to happen by the end of this year if rate hikes go as quickly as the market expects. Now, growth wouldn't necessarily need to fall drastically below trend, but it's possible that it would push the economy in the US or Australia into a couple of quarters of negative growth. And that's the technical definition of a recession, and that's what markets are worried about. And that is what we're seeing in equity markets at the moment. That 20% drawdown is markets saying, hey, we are worried that the RBA will get this wrong. We're worried that the Fed will get this wrong. And that would drive a recession and that would result in another leg down in equities. So that's what we're seeing priced in at the moment. And there's quite a few things to keep an eye out for here. One is a Fed that keeps saying we're just going to keep hiking 50 basis points over the next year or so until inflation gets to 2%. That would be a challenging narrative for them to be able to sell to markets. The other thing to look at is for bond yields, which have moved very, very fast in an upward direction. We're talking a bond yield in Australia for a 10-year moving from below 2% to now up to 4%. That's a 2% increase over the course of this year. If they were to start to reverse and move lower, it would be the bond market saying, we think growth is going to slow. We think you've over-tightened. The economy is going to shut down and you're going to have to cut rates. So we're keeping a very close eye on what goes on in those bond yields, because they're a good leading indicator of how the economy may start to move and where we might start to see markets move. So there's a couple of scenarios there. A softer landing, one which is pretty robust, fairly benign, and would help reverse some of the challenges we're faced. There's a hard landing there, which is a real risk and one that we keep a close eye on and we try and protect against to the extent that we can. The part that I haven't mentioned but I alluded to was the risks around the Australian economy from rates moving higher and the impact that could have on households, because we have a cash rate here in Australia. The Reserve Bank sets the overnight cash rate. It's increased it from 0.1% to 0.85% over the last 2 months. But it was at 0.1% for quite a while. And before that, it had been moving in one direction and one direction only through the pandemic. And that was down at the same time that they were pumping liquidity out into the economy by buying back bonds. And that provided a big boost to asset prices, not just equities, but those who own property or who have been looking to buy property over the last year will know that it's also supported house prices. And house prices across Australia, I'm just taking the Australian average here, were up about 30% over 2021. And that was really driven by support from monetary policy, support from government as well during 2020. And we saw a sharp increase. But there are risks to that. Now, the RBA knows that their monetary policy, their cash rate, is not the rate that most people who buy houses pay. They pay standard variable or some version of that. Increasingly, people have fixed rate mortgages, but eventually they will roll off to standard variable. And that standard variable rate is quite a lot higher than the cash rate. Currently, the gap between the cash rate and the standard variable is about 4.5%. And that's widened. It's widened quite a lot over the last 10 years or so. It used to be about 1.8% about a decade ago. It's moved to 4.5%. And there's a risk that it could widen further. It widens further as our domestic banks face higher costs of their own funding, or if they see higher risks in the housing market, they will aim to claw back or add margin to their loans by widening this standard variable rate. So what is this saying? This is saying that if the market's right and we get to a 4% cash rate by the end of this year, we're staring down the barrel of an 8.5% standard variable mortgage rate by December. Now, that would be a challenging shift higher in terms of percentage increase in repayments, monthly repayments, because it's effectively doubling the standard variable mortgage rate compared to where it was 3 months ago. And the Reserve Bank knows this. They spend a lot of time thinking about the impact of their monetary policy decisions on the housing market, because that is the transmission mechanism through which they expect to be able to really control the market. And it's a direct line in. They don't need to worry about the fixed rate mortgages so much, a little bit more than they used to, but they can directly impact household spending through this channel. And they'll be looking to do so, but not looking to cause a multi-year crash in house prices. They're not looking to drive a recession in Australia in order to bring inflation under. They're not purveyors of the recession we had to have, a la the early 90s. They are looking to gradually slow the economy, inflation, house price growth in an orderly fashion to give that soft landing. Now, there's no doubt that even if we don't get to 4%, even if we get to that 2.5% to 3% probable outcome, that higher standard variable rates will weigh on activity. And what we see historically is that tends to result in less borrowing, fewer construction approvals, less residential construction, therefore less spending on filling a new house, and slowing inflation, slowing house prices. A good range for the type of move you may see from what we think of as our probable outcome is somewhere around 10 to 20% decline in house prices. Now, we see that as a near-term outcome rather than something where house prices fall and then plateau for many, many years. But there is a risk of that decrease. And I think it's important to put that in perspective with that 30% increase over 2021, that house prices will still be up over a 2-year period, but the likelihood is that higher rates will weigh on prices in the near term. Now, I say that for us is a near-term thing rather than a multi-year or medium-term outcome, because we actually remain, after that initial impact, relatively positive on house prices. And there's a few reasons for that. We know that house prices were supported by very robust liquidity and accommodative monetary policy over the last year and a half. But that came at a time when there was virtually no external demand. COVID resulted in a complete shutdown in immigration, and that is going to reverse. We know that that will reverse over the next couple of years. And from our experience, we find that in-migration tend to buy houses about a year and a half after they move into the country. So you have this initial impact from rates, and then a year and a half from now, there'll be a significant increase in demand as recent immigrants look to buy property And that was the experience we saw in 2011 and 12, that it was the migration that really helped support house prices after that, the initial shock lower.
Isaac just had a question about if interest rates was the only lever that the Reserve Bank has to pull to address inflation. Yeah.
It's not the only lever. So they can also, and have also started a process of credit tightening or quantitative tightening, where they reduce the amount of bonds that they hold in their balance sheet. So they sell that back, and that would allow them to sop up some liquidity in the economy, reverse that very easy monetary policy, and they'll start doing that for sure.
Yeah.
But it's even, that's not the only one. I'll get to the other one in a second if there was another question, because that follows on.
Yeah, I was just going to say it's obviously a very tricky balancing act there for the Reserve Bank in terms of trying to manage those households with their obviously challenging inflation costs and mortgage repayments, the property market, and then at the same time you're trying to sort of balance it all out. It must be very, very difficult for them. So yeah, certainly interesting.
It's a real challenge, and I mean, they will and have copped a lot of flack over the last couple of months for getting it all wrong, for waiting too long. But of course, they're a conservative institution, and they came through the pandemic having taken out a lot of insurance and explicitly saying that they were taking insurance. They probably held on to that for too long, and now inflation is higher than they would like. But it's not in their nature to err on the other side and clamp down just to make up for it. I think they will take a conservative approach to hiking rates. That doesn't mean there's no hikes to come. Hikes are coming. They're probably going to get to 2.5%. But the market expectations for 4% would be a lack of conservatism, in my view, from the RBA. And there are other reasons why the RBA can hold tight a little bit, and they may choose to hold tight a little bit beyond just the fact that there's a whole lot of inflation that they can't do a great deal about. So we have a situation in Australia that is caused by a very unfortunate circumstance, or at least partially caused by a very unfortunate circumstance in Eastern Europe. The war in Ukraine is really curtailing supply of a whole lot of food and energy and commodity resources, because they simply won't be dug out of the ground, they won't be harvested, and that's putting upward pressure on prices. It turns out that Australia also happens to dig those commodities out of the ground. They also happen to supply those soft commodities, agricultural commodities, food, to the rest of the world, and they're stepping in to provide some of that supply at a time when prices have gone through the roof. And this chart, again, I don't love to put charts on there, but there's no better way of showing it, shows the Reserve Bank of Australia's commodity price index, which is the weighted average of prices of the commodities that we sell to the rest of the world. Predominantly iron ore and coal, but there's a very significant weighting to agricultural commodities. So soft commodities, meat, grains, vegetables, some energy, LNG, and the like. And you can see here that prices have surged compared to what used to be a multi-decade commodity boom back in the late 2000 noughts. You can see that prices have kept rising, and this when you see commodity prices go through the roof like this in Australia, the things that we export to the rest of the world, it delivers a really significant boom to our terms of trade. And the terms of trade can just be thought of as the price of what we sell versus the price of what we buy, or put it another way, when it goes up, we're getting a big one-off income transfer from the rest of the world to our country. Now, in the past, that has boosted the Australian dollar, and we remember that, I'm sure everyone here, back in 2012 through to 2013 or 14 or so, when the Australian dollar broke through parity with the US dollar, as a direct result of that terms of trade boom. It hasn't happened so far And that's partly because there's a lot of uncertainty. We have a risk-off environment. We have concerns around Asia. We have people people switching to US dollars for safety, and that's putting downward pressure on the Aussie dollar, but that doesn't mean it has to persist. If we get a soft landing, or we start to get a soft landing, that will be supportive of the Australian dollar, and a tighter Australian dollar acts like a rate hike for the RBA. So I think you'll start to see them perhaps talking up the Australian dollar, hoping that will do some of the heavy lifting for them. And that will be an important part of them managing a soft landing. So I'm coming to the end of the time, and I do want to keep time for questions. But just in summary, I think it's useful, again, to point out this has been a really challenging time. It's been driven by significant uncertainty, not just in the economic outlook, but at the central bank outlook. That's pushed rates higher, and that's put downward pressure on equities. Markets are starting to price a recession that we don't think is a fait accompli. It may not happen. That will come down to where rates get to over the course of this year. And we think they will go higher less aggressively than what the market is pricing. That gives us some optimism over the coming year. We are watching it very, very carefully, as you can imagine. We do have some signposts and scenarios for managing that, and we are taking actions to try and protect the portfolios. But it doesn't get away from the fact that in the near term, we should be prepared for some more volatility.
Thanks very much, Isaac. Great session. Lots of really great takeaways there, I'm sure, for the group. I think, yeah, we've got a couple of questions that have come through. One of the questions was why fixed income was so negative over the 12-month period, and how that comes about when you'd expect sort of fixed income and say bonds to perform, perhaps in the positive or something like that. But certainly, those sort of negative numbers are quite, unusual for that particular asset class. So yeah, just interested in that particular topic.
Yeah, it's a great question and such an important one. Fixed income in a portfolio has traditionally been the defensive asset, but it also has other roles. It can and ought to provide income, diversification, downside protection, and we saw over the last 40 years or so that it can provide capital appreciation as well when yields go down. But over the last 12 months, what we've seen is a very rapid move higher in rates. And when rates move rapidly higher, fixed income prices fall so quickly that the higher income from the higher rates can't offset the capital loss. And that's what we've seen over the last 12 months. Now, that's changing now, because when you look at a government bond, a 10-year government bond, for example, that we know will get paid back, Australia is always going to pay back its bonds. The US will always pay back its treasury bonds. You're getting 4% income there. You're getting 3.5% income. And prices, yields may move higher, but they need to move much higher. They need to move to 6 or 7% yields in order for that capital loss to offset the higher income. So while it's been a truly challenging 12 months, bonds are now starting to offer a more attractive combination of income and downside protection.
Yeah, great. And it was, I suppose, because of the rapid move in rates, and I suppose older bonds locked in at lower rates that sort of impacted that in that way. Yep. Yeah. Okay, good. We've got a bit of a crystal ball gaze question here about the prediction about the ASX index and the value by the end of the year.
Hard ones, no doubt, trying to mark out over the end of the year. Look, we do think about this in a bit of a scenario way. And as I said, there's a soft landing and then there's a recessionary outcome, and they have quite different outcomes. We still think a soft landing is more likely. We think there's more scope for central banks to under-deliver than over-deliver on rates. Now, we think the Australian market is quite attractively priced. There's a lot going for it there. I mean, the commodity price, terms of trade boom, is very supportive of earnings across a pretty broad part of the Aussie index. So we currently would say that it's somewhere between 15 and 25% undervalued. Now, that provides quite a lot of upside. I'm not going to say that you reprice that all in 6 months. That's perhaps overdoing. But if we get the soft landing scenario, then you do have that sort of 5 to 10% upside from here. Remembering that we are down 5% or so, almost 10% now from the start of the year.
Yeah, I know you and your team do a lot of work around sort of scenario planning, isn't it? Sort of saying, okay, here's one scenario, here's the soft landing, here's the, sort of working through a few different scenarios. And I think that's obviously how to approach it. It's always difficult looking into the future and trying to figure out what's happened. But of course, you're well placed. I guess that's as an economist, that's a lot of what your job's about. Another question's come through here, just talking about people entering retirement. Who are sort of obviously concerned about capital preservation, not wanting to have to go back to work if things don't work out with their investments. So with the potential downside risk, would it be appropriate perhaps to sit in cash and wait on the sidelines and then jump back in after the uncertainty has passed?
I'll answer that carefully because I think it's a great question and a really challenging one.
It is. Yeah, absolutely.
It's going to be very particular to individual situations, but
yes.
I'll take it from an asset allocation perspective. We've seen a lot of negative market movements with a lot of uncertainty baked in, and that has repriced a lot of assets. So as I mentioned about fixed income, a government bond that only a year and a half ago had a yield or an interest rate of well under 1% is now at 3.5% and close to 4%. It hasn't been there at those levels for 5 or 6 years, and so that gives if you think about over the next 5 to 10 years, the starting point of a government bond investment gives you a good idea of what the future return will be and certainly what the income will be. It sort of helps to almost lock away a 3.5% to 4% income yield without a risk that's going to go bust, right? The government will pay it back. So if you're buying and holding, that's the sort of return that you can get. Now in cash rates are moving higher, but they're still 0.85% in Australia, 1% in the US. There's a long way to go for them to get to 3.5% or 4% yields. So that they've got safety in that they're not volatile, but the return is still very low at a point where inflation is 5% in Australia, 8% in the US. So your losses, you're locking in a real loss there for quite a long time in a way that you may not do for bonds. I won't speak a lot about equities because in the retirement phase, this is going to be a discussion with Phil and the team around the regular weighting you need there. But I would make the point that with prices having fallen quite a long way in the US, with prices having fallen quite a long way in Australia, there are relatively attractive earnings yields. In other ways, multiples have become more attractive. And so you are finally, after quite a long time, getting some genuine income opportunities out of a diversified portfolio. And 2 years ago, that was more challenging.
I agree, absolutely agree. And we've seen also with things like annuities or a fixed term style investment sort of getting up around those sort of almost 4% or sometimes beyond for a longer period of time. So I guess for a retiree client moving into something like, perhaps an annuity with a bit of fixed income and maybe a little bit in shares, obviously depending on the risk profile, will be appropriate. One of the things that I've certainly learned over the time that I've been advising, which is about 15 years, is that investing is certainly a game of patience. It's very difficult to guess exactly where the market's going, even with all the best information and the best experts in the world working on the portfolios. But certainly what I do know and have learned is that it's often about time in the market, not trying to time the market, because no one's ever really sure exactly where it's going to go. Would you sort of agree with that? And have you got any sort of other things for perhaps a first-time investor you know, that sort of may have entered the market, say 6 months ago, and just kind of looking for, you know, perhaps quite concerned about where things are at the moment?
I very much agree. You know, it's that mantra of time in rather than timing is something that we firmly believe in. It is really difficult to know when markets will move up or down in the near term. But what we know is, as you move out your time horizon, the probability of having negative outcomes declines. Over a 10-year period, the probability, if you invested 100% in equities, the probability of having a negative outcome is about 6%. It's quite low. And so it gives you certainty. Taking that longer term view gives you more certainty about the types of returns you can achieve and the type of journey that you will have. And I think the other interesting maybe stat or point is you can't time the down days and you can't time the up days. But if you take away the 20 biggest up days in markets over the last 10 years, your return falls away dramatically. And you simply can't time those good days. So it is a matter of just being in there, being aware of the risks, being aware of the near-term volatility, but also understanding that longer term does pay off.
Absolutely, yeah. So I think that often the original time frame that perhaps an investor was thinking of with a portfolio, sort of often think about, you know, pulling that out and sort of thinking and of course readdressing the risk profile. Of course, that can change over time as people's different feelings towards markets can change as well. I was just going to sort of pick up the question around, you mentioned about, was it a 10 to 15% potential undervaluation for Australian equities? Probably a difficult question, but, you know, would you be able to give the audience a bit of a sense of where that comes from and what sorts of things would you be thinking of, what types of companies perhaps even that you'd be thinking of in that sort of narrative?
Yeah, sure. So we model out what we think is a fair value in equity markets, and the things we think about is potential revenue growth, profit margins, and payout ratios, dividend yields, if you like. And we think that just given where markets have got to now, prices have obviously declined 10% or so at a time when underlying revenue growth is pretty strong, and that commodity boom that we've seen is pushing that even higher and probably will continue to be realised over the course of this year. It really does mean that markets have just been very pessimistic about not just the near-term outlook, so the next 3 years, but the medium term, out 5 or 7 years. So they're effectively pricing in some sort of earnings recession over the next couple of years. We don't think that's the case. So it provides quite a lot of upside. But as you mentioned, we do think about scenarios, we do think about risks, and the way we've thought about implementing that or investing that is less around sectors and more around quality. And so you think of the best companies in Australia, the strongest managers, the strongest balance sheets, the most predictable cash flows. Right now, at least, you know, over the next few years, give you a bit more downside protection against the fact that, you know, what if we're wrong? What if the RBA does decide to hike by 5% this year? You want to have some of that downside protection via quality companies, but still be invested.
Yeah, fantastic. Absolutely. And I was just, looks like we haven't got any other closing questions. If anyone's got questions, please feel free to add to the Q&A section within Zoom. There's a spot there to add your questions if you have any last minute ones to add in there. I think you know, just talking here about, so you talked about energy prices and iron ore and sort of commodities, and we saw that the chart, you know, obviously heading in the right direction. I always find it really interesting about how, you know, companies like, I think, Fortescue Metals, Rio were some of the biggest falls yesterday. It's surprising when the commodity prices is sort of going up. Is it just that companies like that just get caught up in the noise, or is there more to it?
I think part of it is index construction. They're the largest parts of the index, and so people want to express a negative view. They'll sometimes just hit the sell button on everything, and you know, and that can be quite challenging. if on a day-by-day basis, there could be a swing in a commodity price that kind of gets people to sell. But daily moves can be very painful and sometimes easy to explain in hindsight. But when you stretch them out, I think when you stretch them out over the next 6 to 12 months, they will probably show up as wiggles rather than sort of big secular shifts.
Yeah, fantastic. And just another question has just come in here. What is the estimated chance of a soft landing versus the hard landing, would you say?
Super hard one. And often get asked this. I'll put it this way. At any one year, there's about a 10% chance of a recession because they happen about every 7 to 8 years. So just historically, without any other information, it's about 10% probability. Now, it's not any other year. We do have some information there. And so the probability of a recession over the next, say, 18 months is a bit higher than what it normally would be. Now, you're going to hear in the newspaper, you're going to hear on news, wild predictions, 50% chance, 60% chance. They are not scientific. They're headline grabbing, and they're really just made up because people need to get their name in the paper in this job. They need to get clicks. I think that the probability of a recession is maybe somewhere between 10 and 20%. So, that's about what it is normally, almost double if we go to 20%. And I think that's a real risk. That's a genuine concern for us. But more likely than not, we don't have a recession.
Fantastic. Well, thanks so much again for your time today, Isaac. Just conscious of time and sort of keeping it within the hour. But I think we've covered some really, really good ground there. For any participants that actually have any questions post this session, please feel free to email them through to either your advisor or advice@endorphinwealth.com.au, where we'd be happy to sort of answer those questions offline individually. There's absolutely no problem in doing that. But yeah, thanks again for your time, for everyone coming along, but also to you, Isaac, for your excellent insights. And thank you again for helping us navigate, obviously, I think the word challenging was said there. I was thinking if we're having a bingo on a word, it was the word challenging for sure. And I think, there's no question that it certainly is. And so for me and certainly the clients that we're speaking to, it's thinking about long-term, thinking about, quality companies like you talked about. And of course, in our portfolios, there's a lot of work that goes into not only the positioning of the portfolio globally, like which particular markets at what times and the mix of bonds versus shares, but also the individual companies that we're invested in. And there's a lot of work that goes on through quality investment, research and allocation that goes through that. So yeah, I'd certainly encourage, participants in this session, but also clients of ours to, talk with advisors. We're always happy to have a chat with you and certainly happy to, talk about anything that you might be feeling at this time, because it's, as we know, very challenging. And yeah, have a wonderful day and look forward to talking soon.